Okay, hello everyone. I hope you're all doing well. Today I'm going to be talking about what is a good business, and then also just understanding competitive advantage and returns on invested capital and kind of how it all goes together. It's going to be a pretty qualitative video, and I'm going to try to limit accounting jargon as much as possible. So first, just getting into the $1 test, which I think Buffett was famous for coining. But basically, when we think about if a business is good or not, a lot of times it can just come down to this. If I'm investing $1 into a business's operations, how much value will that investment create incrementally? So we know a $1 cash outflow right now means that for this investment to neither create or destroy value, we need at least a present value of $1 in incremental cash flow to come as a result of this investment. So if we have a present value of $1 as a result of this $1 cash outflow right now, that will neither create nor destroy value, right? Because NPV will be zero. However, if this cash outflow creates more than a present value of $1, then it would be creating value. And if it's creating less than a present value of $1, then it would be destroying value. So let's put some numbers here. Let's say that the cost of capital, which is the discount rate for my business, is 10%. And this investment of $1 is increasing my cash flow by 20 cents incrementally in the perpetuity. So a perpetuity of 20 cents, the present value of perpetuity is just the cash flow divided by the discount rate. So it's just going to be 20 cents divided by 10%. So this investment of $1 would have created $2 in value. So -1 present value of the outflow, $2 the present value of the cash inflows, and that will be a net present value of $1. So you can see here that in this case, because my return on invested capital, which is just my profit over invested capital, is equal to 20%, and my company's cost of capital, the discount rate is 10%, this is creating value for us. ROIC, return on invested capital, you can kind of just think about it as the IRR of incremental investments into a company's core operations. So we can always compare discount rate to IRR. Similarly, you can compare return on invested capital, which is the IRR of a company's incremental investments, to a company's cost of capital, which is basically just a company's discount rate. So similar to how when you have an IRR above WACC, this would be positive NPV. It's the same thing here. When we have ROIC above cost of capital, the NPV is positive, and therefore value is being created. So really, when you think about a good business, it should be passing this $1 test, right? A good business is one that, through a formidable competitive advantage, what Buffett would probably call a moat, the business can consistently earn a higher ROIC than its cost of capital on its investments and thus create value. So a good business is one where they can consistently do this. They put $1 into the business, and the present value of the future cash flows as a result of that investment will be more than that dollar that you put into the business. And that happens through having a formidable competitive advantage, or what a lot of people would call a moat. So the good thing about this happening, right, is if you are investing money, and as a result of that, you're getting more money out of it, return on invested capital above your cost of capital, then you're going to create more value. And then you're going to have more profits in the future that you can reinvest again and create more value and more value, more value. And it's a kind of a compounding effect, right? So that's why a lot of the best companies and the best performing stocks over time have been companies that have had high return on invested capital as a result of a competitive advantage that has persisted for a very long time, because they're able to continually compound their earnings, because they're able to basically have pretty positive earnings, and then they're able to use those earnings to reinvest in their company and get high returns on those reinvestments, which creates more earnings and then more reinvestment opportunities. So the most prolific at it, of course, has been Warren Buffett, right? Probably the best allocator of capital in the history of capital allocators, right? If I had to guess. And you can just see by Berkshire Hathaway's stock performance that that has certainly been the case. Other ones, Monster Energy, which has done phenomenally. I think it's probably the highest performing stock of the last 25 years. Additionally, Costco, which has done amazingly as well. And it's just so interesting compared to other grocery store companies, how they've been able to come in and basically create a moat, which I can get into later. And then the last one, which is a newer company, which has been famous for basically, I think it's 100x in at least the last 10 years, is Expel, which is, I don't know exactly what the company does, but it has something to do with paint. I just hear about it on Twitter a lot. But these are some examples of compounders, companies that are getting high return on invested capital and reinvesting their earnings and reinvesting those earnings and basically just growing a lot and creating a lot of value as a result of that. So I kind of want to remind you that growth does not equal value creation. Growth is only good when your return on invested capital is above your cost of capital. Because otherwise, if you're growing faster, you're effectively destroying value faster. And it's also important to note that businesses cannot earn high returns on capital forever. And it's important for a business's management team to recognize when it cannot create value anymore through incremental investments. I think we all have a bias of overestimating our ability, and that is certainly true with management teams of publicly traded companies. Of course, it's the management team's fiduciary duty to maximize value for shareholders, and they know this, but a lot of times they might overestimate the abilities of their reinvestments to produce high returns on invested capital. And as a result of that, they might end up destroying a lot of value for shareholders. So it's important for a management team to be self-aware about their reinvestment abilities, especially companies that are near the end of their life cycle. For instance, newspaper companies used to be amazing businesses. Back in the day, basically before the internet, if you think about it, newspapers have a lot of monopolistic characteristics, right? If you own like the Dallas Morning News or one of these newspapers in a local market, you're pretty much the only news provider of the news that's happening in that market. So you have a lot of leverage over your customers, right? They're going to be willing to pay a bit more for your service, and you probably have pricing power there. Pricing power is just the ability to increase your prices and for your customers to continue paying that. If the Dallas Morning News increases the newspaper from $1 to $1.05, like, are the customers really going to cancel their subscription, right? It's such a small increase in the grand scheme of things, and they still probably want their news. But it's going to end up being really nice for newspaper companies in the long run. Additionally, even more of the way that a lot of these newspaper companies make their money is through offering the advertisers, like local businesses in those markets, the opportunity to advertise their service, right? Basically, like if you own the Dallas Morning News, you basically have a pretty big share of the advertising business in Dallas, right? If a business wants to market themselves, to want to advertise themselves, they are probably going to be willing to pay a decent amount to put their advertisement in your newspaper. So it's really nice to own a newspaper company until, of course, the internet comes out. That completely disrupts the newspaper industry. Obviously, there's still newspaper companies. A lot of old people, my grandparents, shout out them. They still have newspapers being delivered to them, but it's just not the norm anymore. Most people get their news off the internet. So as a result of that, newspaper companies really do not have that many good reinvestment opportunities, right? For instance, a lot of newspaper companies have tried to become like technology companies or try to transform, but a lot of times that really doesn't end up working out, right? You can think in your head, like as a newspaper company, oh, I'll be able to transform into a digital company, or I'll be able to do this or this. But a lot of times it's just in the best interest of your shareholders for you to just return that cash to them in the form of a dividend. It's kind of a similar dynamic for tobacco companies. Tobacco companies are very aware of this, and that's why if you look at tobacco companies, they pay very high dividends. It's because these companies, it's still a pretty good business, right? You can basically make a cigarette for a cent, sell it for $1. Very addictive, unfortunately. So people are going to come back. You're going to have a lot of recurring, sustainable revenue, right? But there's, a lot of, anti-smoking propaganda. Less people are smoking in our generation. And it's kind of a melting ice cube along with the newspaper industry. So because there's not many good reinvestments, it's in these companies' best interest to not try to grow into areas where they don't have any expertise and rather just return that cash to shareholders, right? Because then shareholders can decide what do I want to do with that money, right? So when you don't have any investment opportunities where you're going to confidently get a return on invested capital above your cost of capital, so an IRR above your discount rate, and thus have a positive NPV, you should really just be returning that cash to shareholders because they'll be able to get more value out of that money than you would, because you would effectively be destroying value, right? For instance, if I was investing in a stock of a tobacco company and they started trying to transform into a technology company because they wanted to grow, and they're like, hey, technology is where it's at, that's where all the growth is happening. Me as an investor, I would certainly not like that, because if I wanted to invest in a technology company, I would just put my money in a technology company, right? I'd rather this company just give me a dividend. And then if I want to invest in a technology company, I'll use my money to go put it in there. But I don't want them to be investing in very speculative, these transformative projects that are probably going to fail, right? So I just want to remind you that growth is only good when your return on invested capital is above your cost of capital. Growth in and of itself does not equal value creation, right? If your ROIC is above your cost of capital, growth is good. The more growth, the better. If your ROIC is below your cost of capital, the more growth, the worse off you are as a shareholder, right? So now I kind of want to talk about like the basic economics of a business. So every business has sales, right? They have variable costs, fixed costs, and incremental investments. And incremental investments are going to be a big part of what we're talking about today, because a lot of how we determine if a business is good at its core is its return on invested capital, which is basically measuring the profitability as a direct result of the incremental investments a company makes. But before I get into all of that, let's just explain these basic economics of a business. So we all know what sales are, but let's get into the other three. So variable costs, these are costs associated with additional sales that a company generates. So basically, variable costs are costs that if a company sells more products, the variable costs are what is going to be directly associated to that. So for instance, if I operate a lemonade stand, the variable costs are the things that go up when my sales go up. So for instance, like the cost it makes me to buy the lemonade, right? Because the more sales, the more I'm going to have to go to HEB to buy lemonade. Fixed costs are costs that are fixed and stay the same no matter what the volume is. So it's kind of the opposite of variable costs. These are costs that are set in stone and really should not be affected by any changes in volume. It doesn't matter if we sell 0 products or 200 products, or 0 volume or 200 in volume. Fixed costs should be the same, right? Theoretically, in a COVID scenario, where you basically have no revenue because the entire economy is shut down, you would have no variable costs, and all you would have left are fixed costs, right? So that's kind of the difference between variable and fixed costs. And the last thing is incremental investments. And these are basically investments by a company now into tangible assets such as like factories or inventory, or also intangible assets such as like marketing, or the brand, stuff like that. So investments that will increase the company's earnings power in the future. So what do I mean by earnings power? Earnings power is basically the cash flow generating abilities of a company with its current operations, assuming no incremental investment. So this is basically if a company just decided to go into harvest mode and not grow anymore, earnings power is what they could generate in cash flow. It's just revenue minus variable costs minus fixed costs. Of course, incremental investments are a cash outflow. So there's kind of a trade-off here, right? Incremental investments are investments into fixed capital. So these are like long-term assets, tangible and intangible, held by a company, such as like a factory or investing in the brand through like advertising. And then also working capital. So like investing in having more short-term assets, such as inventory or prepaid expenses. So basically, the idea here is that a company has a certain amount of earnings power at any given moment, right? That's just based off of all of the operations that a company has right now. If they just stop trying to grow and investing incrementally, they could just have this much in cash flow. But of course, most companies are trying to grow. Most of them are trying to invest in themselves, trying to expand, things like that. So almost all of them are going to have some sort of incremental investments. Incremental investments are essentially, it's a trade-off, right? They're decreasing your cash flow right now, but hopefully in the future, because of them, they're increasing your company's future earnings power. And that's kind of why it's important to look at ROIC in comparison to cost of capital to see if these investments are positive in PV, because you want to see, okay, is it really worth this trade-off? Should I really be reducing my cash flow now to be increasing it later on? Sometimes it is, sometimes it isn't. For instance, Amazon is notorious for this. If you go look at the cash flow of Amazon from 1995, since like around its inception to now, you would see that basically up until like the 2015, 2019 like ish time period, they were like just at a higher and higher cash flow loss, right? They were losing more and more cash flow because they kept reinvesting more in themselves, right? Even though Amazon had a positive earnings power, they had negative cash flow because they just kept reinvesting and reinvesting and reinvesting. But the thing is, now it has paid off because Amazon produces so much cash flow, because instead of focusing on the short term, just like getting cash now, they were trying to build something that no one else could replicate, right? If Amazon, instead of focusing on these reinvestments, focused more on just being profitable in the short term, other people might have been able to overtake them, right? But because they were able to take a long-term approach, that's what Jeff Bezos always says. That's one of Amazon's advantages, is they're not thinking in terms of 1 to 3 years. They're thinking in terms of like 6 to 8 years, longer than their competitors are thinking, which then gives them an advantage. So basically, Amazon was willing to make this trade-off, and Amazon is, known for creating a ton of shareholder value. I mean, just look at the stock chart over the last 30 years, right? They've been able to develop wonderful businesses, not just in their, like normal e-commerce business, but also in Amazon Web Services, and they're expanding into a lot of different things. Not everything has been a success for Amazon, for instance, like their cell phone, but more often than not, their investments have, turned out to be very well. So, or went very well. But I kind of just wanted to explain this. So I basically said that a company can make incremental investments into fixed capital and working capital. And I think this might be confusing for you, because you might be thinking, Carter, how are you investing in inventory? Isn't inventory like a variable cost? How can inventory be a variable cost and an incremental investment? So I just wanted to have a slide kind of explaining that, because it'll be more relevant when we talk about valuing businesses as well. So before we get into accounting, I just want to kind of talk about this concept. So basically, if variable costs show up as a cost to incremental working capital investment, and both of these decrease my cash flow, wouldn't that mean I'm double counting when a company invests in inventory? So that's kind of the premise of this question, right? And I'm going to prove to you that it would not be double counting, and that it's appropriate to sometimes classify inventory as a variable cost and sometimes as a working capital investment. Inventory will always show up as a cost when it is sold. However, inventory only shows up as an incremental investment when a company increases the value of their inventory that they keep on hand, because that is decreasing cash flow to hold more inventory. So basically what I'm saying is, most companies hold a certain amount of inventory just on hand at all times. Maybe at first my company holds $1,000 worth of inventory on hand every year, but now my company's expanded so much that it always holds about $10,000 worth of inventory on hand. Well, going from 1,000 to 10,000, that's a $9,000 cash outflow. So that's basically the kind of investment I am talking about, right? It's making an investment to hold more inventory, on hand. That's going to cost me money, but I'm hoping that because I have more inventory, my earnings power is going to be higher in the future as a result. So, for instance, if a company consistently keeps $1,000 worth of inventory on hand, and they just, periodically sell that inventory and then buy more, but they always just have exactly $1,000, there's going to be no incremental investments associated with this, right? They just always have 1,000. But if over time I gradually go from having 1,000 to 5,000 worth of inventory on hand, then this would be an incremental investment, because the company is decreasing cash flow now to increase earnings power later. Something I just wanted to touch on, which I think is pretty interesting, is that some companies have what is called a cash conversion cycle, which basically means that they actually make a negative incremental investment when it comes to working capital, which means that they're basically getting money to grow, which is a weird concept. But basically, think about it like this. Amazon, I'm going to go back to them as an example, although it's an unrelated topic. basically what Amazon does is they are getting inventory from a supplier, right? If you buy a book off of Amazon, Amazon's getting that from some supplier. So what happens is if you make a delivery, if you buy something on Amazon and you're entitled to getting it in 10 days, what's going to happen is this is not exactly accurate, but it's going to be something along the lines of this conceptually. Amazon will go to the supplier and say, "Hey, provide me with this book," right? So Amazon will get paid in cash by the by me, the customer, if I'm buying this book right now, and then they'll be like, "Hey, supplier, go get me that book so that I can give it to the customer." And what happens is they actually get the money from me for the inventory before they end up paying the supplier. So what happens is Amazon is basically getting money first from me before they pay the supplier. So it's what's called like negative cash conversion. All right. I don't know if that's exactly, I think it's called negative cash conversion, but I do know it's a negative incremental investment because as Amazon grows, basically they're going to keep benefiting from this because as they hold on to more inventory on their balance sheet, or the more, I don't mean to use accounting jargon, the more inventory they hold on hand, the more of these negative incremental investments. So basically, you can think of inventory for Amazon as like a source of funding because they're getting paid for it first by the customer before they actually have to pay the supplier, which just happens for Amazon because they have such leverage with suppliers, right? If you're a book company, you really want Amazon to be able to be the one that's selling you really want to be the one that's providing Amazon with books, right? So you're willing to go along with these terms that are really nice for Amazon and not as nice for you. So because Amazon is just such a big company, they have this advantage here where they can have this negative cash conversion cycle or negative incremental investments, which I think is pretty interesting. But normally, as a company expands, it's going to be a cash outflow for them to hold more inventory on hand. It just happens to be the opposite for Amazon. So this is just like a quick example. I'm not going to go through it. You can read it if you want, but it's basically saying how you separate out the variable cost and the incremental cost here. I guess I'll just go over it real quick. If I have $4,000 worth of inventory at my house at the beginning of the year, and I sell $10,000 worth of inventory during the year and end up with $4,000 worth of inventory, then like I didn't make any incremental investments. I ended up with the same amount of inventory on hand as I did at the beginning of the year. So the beginning and the end, I had 4K and I sold 10K. That 10K that I sold is going to be the cost here, right? It cost me money because I basically sold $10,000 worth of inventory. So I only had 4,000 at the beginning of the year. So that must have meant I was buying more throughout the year to sell. And then I ended up at 4,000. So if I sold 10,000 and I started with 4,000 and with 4,000, well, presumably I must have spent 10,000 throughout the year restocking my inventory. But that shows up as a cost because I sold all of that inventory. Whereas in the second example, if I instead have $4,000 worth of inventory at my house at the beginning of the year and then sell $10,000 worth of inventory and then end with 8,000, then that means that I did make an incremental investment because I sold 10,000, but I ended up paying 14,000 for inventory throughout the year. 10,000 was just the amount I spent to sell the goods or to buy the goods that I sold, right? Because it's inventory. Where the 4,000 is the incremental investment here because now I'm holding $8,000 worth of inventory on hand rather than 4,000 on hand, right? So that's going to show up as an incremental investment. You don't need to understand this now if you don't really have a good understanding of accounting. I just kind of wanted to clarify the difference here because it might be confusing. Inventory showing up as an incremental investment and a cost. So basically, inventory is a cost when you sell it, but if you're holding more inventory on hand, that's going to be a incremental investment for you to be doing that. Why would you want to hold more inventory on hand? Well, naturally, the bigger a company you are, for efficiency purposes, you're going to need to be holding more inventory in hand. So for efficiency purposes, you're going to want more inventory in hand. So hopefully by doing this, your earnings power potential will be bigger. So it's an incremental investment, again, to increase your earnings power. So now I just want to like show a simple example to kind of explain the unit economics behind all this. So let's say there's a lemonade stand, and let's say that I'm starting this stand up by myself. I'm trying to make some money, and I invest $2,000 in incremental investments to get this thing started. So this includes the lemonade stand, inventory, poster, a magic formula. I come up with some, combination of lemon, sugar, and water, or whatever, however you make lemonade. I always just buy it pre-made from the store. And then also some marketing, right? Maybe I go around campus, print out some flyers, and I set up my lemonade stand on Speedway. And let's say that every period I have to pay $1,000 in fixed costs. So these are just costs that I'm gonna have to incur, right? Doesn't matter how much in sales I have. I'm just gonna have to pay for maintenance and repair on my stand and poster. I'm gonna have to pay utilities, and I'm gonna have to pay insurance, right? Those are just things I have to pay, right? And let's say unit economics, I charge $2 per cup, and each cup has variable costs per unit of $1. So if I sell 2,000 cups per year, 2,000 times two, 4,000 in revenue, minus 1,000 in fixed cost, which is just going to stay the same, right? It's fixed. And you subtract 2,000 in variable costs, which is just the $1 in variable cost per unit, times 2,000 cups that are being sold. So here you can see I have $1,000 in profit, and this is clearly a great return on invested capital, right? I'm only investing 2,000. In my first year, I end up with $1,000 in profit. So I'm loving life right now. This is a great investment for me. If I just keep running this for a few more years, I'm easily going to get my money back and then more, because my ROIC is so much higher than my discount rate, right? Presumably my discount rate, my cost of capital might be like 10% or something like this, or let's say it's 8% actually. So the problem is that we live in a free market. And if other people on Speedway see that I'm a lemonade stand and there's a huge line, and they might infer that I have a big ROIC, then people are going to come in and try to start lemonade stands of their self. That's just how capitalism works, right? And when that happens, there's increased competition. So of all the people, there's less people that are going to want to buy my lemonade, because they might flock to the other person's lemonade stand. So maybe because of this, I have to lower my prices a little bit, because I'm like, shoot, what if that guy that started the other lemonade stand went in and undercut me? Then I'm gonna have to lower my prices, and then volumes are probably gonna decrease by a little bit anyway. So in this case, my prices go from $2 to 180, and my volumes decrease by 10%, right? So now my volume is 1,800 in like lemonade cups sold. And let's say I also have less bargaining power over suppliers. Maybe before I'm the only lemonade stand business, so I can convince HEB to give me a good rate. But now there's other lemonade stands, so I don't have all the power. And maybe as a result of that, because there's more demand for lemonade, because there's more businesses, maybe the variable cost per unit go up to 120. So it doesn't look like that big of a deal, right? From $2 to 180, $1 to 120 in variable cost per unit. But if you look and do the math of 1.8 thousand sales times that price minus the fixed and variable costs, you end up with only an $80 profit versus $1,000 here. And your ROIC is only 8%, which is probably right around your cost of capital. So you can see here, when there's increased competition, and as a result of that, you have to decrease your prices, volumes go down, and maybe your variable costs per unit go up a little bit, your returns on capital can erode very quickly. And a business that seems great is now pretty lackluster just from this happening, more increased competition. So I kind of just want to break down ROIC, because the formula is just profit over invested capital, right? I'm not going to use any complicated accounting terms, so we're just going to call it profit over invested capital. So just I'm going to invest this much capital in incremental investments. How much incremental profit is it going to create? You can kind of divide by fractions here, I guess multiply these two fractions and get to the same thing. Basically, ROIC is revenue over invested capital times profit divided by revenue. So it's basically ROIC is a function of the efficiency that a company increases revenue when deploying capital. So per amount of capital deployed, how much revenue it generated, and then the incremental margin on those sales. That's effectively what ROIC is measuring, right? revenue over invested capital times profit over revenue. Some companies are going to excel more in the first fraction, for instance, like retail companies, because they don't have to invest much capital, but every single dollar of revenue they're making, they're selling some kind of good, which has a price, right? So their margins aren't going to be as good the second fraction, but their first fraction will be better because they're getting a lot of people in the door. Whereas a technology company, it costs them a lot of capital to start up. So their first ratio won't be very good, but their second ratio will be phenomenal because there's not that many costs associated, especially variable costs, with running like a platform technology company. So now you can kind of see from that example the importance of moats. And moats is really the analogy of like a castle, right? You can think of a business as a castle. And if you're a business that's a castle, you have very good return on invested capital. You want to be protected from other businesses coming in and trying to replicate your business, which is why people call business with a formidable competitive advantage, basically a competitive advantage that like other businesses could not take away or just like easily replicate your strategy. They call it a moat. So you can see Warren Buffett's famous quote: the most important thing to me is figuring out how big a moat there is around the business. What I love, of course, is a big castle and a big moat with piranhas and crocodiles, right? So basically, if you don't have a moat, your high returns on invested capital, because of capitalism, will just get competed away as new entrants enter until they go below the cost of capital, right? So here, your ROIC went from 50% to 8% so easily, right? So that is really what happens, right? If there's more competitors in a space, everyone's going to decrease their prices. Suppliers might get more power, and what's going to happen is returns are just going to go down significantly until it's right around at the cost of capital. And then at that point, you're really not creating value anymore. And it's just like, shoot, man, I was, getting, 50% ROIC. Think about how much value is being created. And now I'm only getting an 8% ROIC. Almost no value is being created. It's effectively not destroying or creating value if my cost of capital is 8%. So that's why a moat is very important. Now I'm going to get into the capital cycle, which is kind of the cycle of capital flowing in and more competitors coming into industries. Basically, the idea here is if you look at the top of this cycle, is when this is kind of like at first when I have my lemonade stand, people see my lemonade stand doing really well and they get attracted by the prospect of high returns. They're thinking, man, I should put some capital into the lemonade stand industry because that prints money. I get a 50% ROIC like that other business. That's amazing, right? But the thing is, as more entrants come in, the rising competition causes everyone to have to lower prices. Volumes might fall. Suppliers might get more bargaining power. And what happens is that returns are going to fall below the cost of capital, right? Or around the cost of capital because there's just too many competitors. And what happens there is the overall performance of the stocks and the underlying businesses are just pretty mediocre. They go down a lot because of this. And then what happens is people are pessimistic, firms leave these industries, there's consolidation within the industries. And what happens is now it's kind of the other side of things because there's so much pessimism, there's less people in the industry, and the ones that are still there can have improving supply side, which basically means there's less people that are providing this good or service, right? So that means that the ROICs will go back up again. So it's kind of this cycle over and over again. I think a really cool one to think about is streaming, right? Streaming at first was kind of started by Netflix. They were one of the first ones in there. They disrupted Blockbuster. But the thing is that Netflix was getting amazing return on invested capital here. I mean, think about it. It costs Netflix almost no incremental money to have another person on their platform, right? It basically is costing, they have a lot of fixed costs, but once they spread out their fixed costs across a lot of customers, they are just printing cash, right? But all these other companies that had a lot of infrastructure already in the entertainment space, like HBO, Disney, NBC, CBS, they basically all thought, hey, I'm going to start a streaming company too, because that's going to make me a lot of money, just like what's happening with Netflix. And what happened is all of these companies are now underperforming because if you think about it, almost no American or non-American is going to want to pay for 10 different streaming platforms, right? It's so annoying. We used to have cable and we thought, oh, streaming's so much easier. We have everything on Netflix, but now you have to have 10 different streaming platforms, right? So it's kind of changed the initial value add of even having streaming in the first place. So streaming really is probably at the bottom here, but I would expect it to start going to the left side of things soon, right? People are going to start to exit, things are going to consolidate, and I think we're going to have a few winners in the streaming industry. Netflix, I think, will be one of them from everything I saw. Like I saw something recently that was saying like a lot of these streaming platforms will have a movie or TV show on their platform for months, and then they'll give it to Netflix. They'll like basically lease out their content to Netflix. Netflix will put that content that was on those same platforms for months. Netflix will put it on for like 2 days, and it'll become like trending like crazy. Like Netflix just like has that kind of like I don't know brand or like advantage of just like people come to Netflix for like trendy shows, you know. But at the same time, a lot of times this kind of hurts Netflix because people aren't really locked in. A lot of times they just watch like one season. It's kind of like a binge watching kind of thing rather than like consistently watching the shows like what used to happen in cable. But basically, the only way to avoid the capital cycle is a formidable competitive advantage, or else you're kind of just at the mercy of your competitors coming in, lowering your returns on invested capital, and then hoping you survive long enough to be able to get high ones again. So that's the capital cycle. I would say that like for like your pretty mediocre slash like below mediocre streaming companies like Stars or like basically besides like the others besides these four I listed here, like Peacock's pretty mediocre if we're being honest with ourselves. I can't even name the other ones. There's a lot of them that just seem like scams, but obviously like Netflix, Hulu, HBO, Disney Plus, like those are pretty good ones. But those other ones, like like they're probably going to be out of here soon. But Netflix has really been able to kind of avoid this. I think that they've done like a pretty good job, and they're kind of like the incumbent. So I'd say Netflix has a pretty good moat in the streaming space. HBO, Disney, Hulu, especially HBO and Disney, have a lot of content. But would you say they have a moat at least as far as like the infrastructure they've set up from streaming like Netflix over like 15-year period? I wouldn't say so, but I'm not an expert on streaming, right? It's to each their own on which of these companies would have the biggest moat. But if I had to say one, I think it'd be Netflix. So that's kind of an advantage of Netflix is they're not at the mercy of the capital cycle like some of these mediocre streaming companies are. They can hopefully generate high returns on capital regardless of what's going on here, although it might affect them a little bit. So I just wanted to go over some like common industry terms. One is market share. This is basically the percentage of total sales in an industry that are generated by a particular company. So, for instance, if I am in the golf industry and I make golf clubs and I basically am responsible for 40% of the total sales, then I would have 40% market share. And typically, companies want to have greater market share, one, just because presumably they'll have more in cash flow, but also they have greater leverage with customers and vendors, which is kind of the idea of like demand side versus supply side economies of scale. Demand side economies of scale is what we call like network effects. This is basically the idea of like Twitter or Instagram. Why do people go on Twitter and Instagram? Because their friends are on those platforms. So the more people that are on those platforms, the more valuable they get. So if you're able to go in and get a lot of customers on your social media platform, that's huge for you because it should happen like exponentially as more and more people get on. That's kind of like what happened with B-Row recently. It became more and more a better company, and like at least for someone that uses it, the more like people I knew that were on the platform, right? And then supply side economies of scale is basically being so big within an industry that you have leverage over your vendors slash suppliers. So for instance, like Walmart has a lot of leverage over the suppliers. They can negotiate really favorable terms versus the the grocery store that owns like one grocery store. They're so small, they're not going to be able to negotiate that good of terms like Walmart might be able to. The second one is TAM, or total addressable market. TAM is for short. TAM is just the total available revenue opportunity in a particular market if 100% market share is achieved. Sorry for the typo there. Basically, yeah, this is like if you got 100% market share, the total revenue available. So this is important if you're like an early stage company and you're targeting like a specific niche area, right? Especially for like technology companies. Because people want to know for a technology company, like, what is the max revenue that you could get, right, from expanding into, this new market or this market. So I don't know if you've heard of it, but Porter's Five Forces is like very famous as far as like how strategy goes for companies. So Michael Porter, I'm pretty sure he's Harvard Business School economist or business guy. I forget, but basically he came up with these like five forces that basically represent the key sources of competitive pressure within an industry. So when you think about like competitive advantage, um, you want your companies to be as little exposed to these five things as possible. So, bargaining power of suppliers and bargaining power of buyers. That's kind of the idea of like what happened earlier, right? With my lemonade stand. The bargaining power of suppliers, the more lemonade stands there were, the less bargaining power we each had, right? Because there's just so many of us, we can't all get favorable terms with like HEB or whoever the supplier is. Bargaining power of buyers, the buyer of your good or service is either going to be a business or it's going to be a person. Typically, um, businesses, if your customer is a business, will have larger buying power. For instance, like Nike, or sorry, let's think of it like as like let's say Walmart is like 20% of some supplier's revenue. So a supplier, let's say they make pet food, and Walmart is 20% of their business. Well, Walmart is going to have a lot of bargaining power over you. They can negotiate really good terms because they're basically like, hey man, we contribute 20% of your revenue. Like, if you don't give us these good terms, we're going to consider leaving. And how's that going to look, right? If you lose 20% of your revenue right now. So that's an example of like the bargaining power of buyers. And then other two are like threat of new entrants. So that's like completely new people coming in. So that's like for Blockbuster, that was like Netflix, like a completely new entrant that just disrupted things. And on the right here, you have threat of substitutes. So for my lemonade stand, that would be like the threat of like a snow cone stand or something else that would be nearly equivalent to the good or service that I'm offering. And then the biggest one is industry rivalry. And this is kind of like people with industry that have already kind of made themselves and kind of thinking about like how people are going to change prices or change their like their mix as far as like the products they offer or what incremental investments everyone's making. A lot of that falls under industry rival, and that's also a pretty critical thing. So now I'm going to have this whole slide just basically on competitive advantage. So competitive advantage is basically the idea of having some sort of like advantage that allows you to have a return on invested capital above your cost of capital in the long run. So when you think about a good business, they're going to have one or more of these things. And that's what's allowing them to earn a higher return on capital or invested capital over the cost of capital for a long period of time. Basically, there's two main ways for a company to have competitive advantage. Either they can charge a price premium over competitors, so they can just charge more for some reason, or they have the ability to produce products more efficiently than competitors. So, and I'm going to basically give examples of real companies, but then also apply them to a lemonade stand. So the first one is just like innovative products. So for a lemonade stand, that would just be like my magic formula, right? Maybe I have this lemonade stand that maybe my lemonade stand is 0 calories and it's like the first one ever invented, right? Then like that might be like an innovative product that is going to make it where people are willing to pay more for my business. Same thing with like a patent, right? Biotechnology companies that get patents are able to benefit from that, and they're the only ones that have access to these innovative products to sell. iPod is another example, right? Creating something groundbreaking like that allows you to charge a higher price for it. The second one is higher quality products. So this would be like if my lemonade was actually just better, right, than everyone else's lemonade. This is like BMW, the car company. People are willing to pay a little bit of a premium because of the actual quality of the car or the good itself. Another one, which is different from a higher quality product, is a strong brand. So this is kind of the idea that like a lot of times some products are like kind of commodities like razors or soda, but one brand will just have accumulated so much brand power over the years that basically people will just flock to their brand, like Coca-Cola, Gillette. I could buy the knockoff Mexican Coca-Cola for way less than Coca-Cola cost me. But I'm probably still going to buy Coca-Cola just because one, it has like a little bit of its own taste, and two, just like the name brand recognition, right? And then the last one is, and that would just be like if I had like a really cool lemonade stand brand. Maybe I just did like an amazing job of advertising my business. And fourth is going to be customer lock-in. So this would be like maybe if I did a subscription service for my lemonade stand, for like kind of like how they do it for Dollar Slice Club at UT. This would be like if I had a subscription service, so people were like locked in basically. They wanted to come and get their lemonade because they wanted to get like out as much as possible from the subscription service. So this is like a good example. This is like business to business software as a service companies. A lot of times like one business will be providing another business with a service. And for instance, like Microsoft, for instance, provides a lot of businesses with Excel and a lot of other IT products, right? Or I don't know if it's IT products. I'm bad at technology. But basically, they're providing them with some sort of like technology product, right? And because of that, a lot of these technology companies are so used to using Microsoft Excel and Microsoft like Office Suite and whatnot that like they have a lot of lock-in here. Similar with like Bloomberg. Bloomberg, almost everyone in the financial industry, financial services industry, uses Bloomberg. So they have a lot of lock-in as well. It's not even like a contractual thing. It's just that like people are so used to using it that like it would be a huge pain to switch away from it. Another thing is like things like analog semiconductors, which I'm not going to get into the weeds of explaining, but basically B2B things where like the service you're providing is critical, but not a big part of like the overall price. For instance, like an example would be like if there was someone that helped with like a small gadget in an airbag that only cost like $10 to make, or at $10 they sold it to the car company. But they could easily like increase that to $20 because like the service they're providing is like so critical that car companies are going to be willing to pay it to make sure that like they get it right, because they don't want someone to die in a car crash because the airbag didn't work. So if you offer like a critical thing for a company that's like overall a small part of like the overall cost for them, like $10 in the grand scheme of things is nothing in comparison to the cost of building a car, then that's a competitive advantage because you have that lock-in and you could potentially raise your prices, right? This first paragraph or the second paragraph on this slide is really the whole idea of like what allows a company to have pricing power. So now I can get into examples of like efficiency advantages. The first one would just be like unique resources. So that'd be like maybe I had access to Trader Joe's lemonade and no one else did. So for instance, a lot of times like mining companies or companies like that, like energy companies that are like extracting things, if you just have better resources, it's going to be cheaper for you to extract it. The second one is economies of scale, which I kind of already went into with Walmart, but basically it's the idea of like if you're a really big company, you can basically you have leverage right over your suppliers to basically ask them for things or get things cheaper. Third thing is scalability slash operating leverage. This is the idea that you have a lot of fixed costs, like streaming, for instance, but you don't have many variable costs. So you're able to spread out your fixed costs out among a lot of different sales, right? So as a result, your costs per like unit are going to go down a lot, right? Which I'll talk about more in the next slide. So like an example of that would be streaming. And then innovative business methods. This would be like if I had like a really efficient way for like making my lemonade that like no one else had come up with. A really cool example of this is like Southwest, right? Almost all the other airlines were like international. They're having to go way more places. Southwest like has a unique like business method for decreasing their costs because they only stay in the US, which makes it a lot cheaper for them to operate. And they only operate in like a few airports, like probably like 30 around the US. Like they don't operate in all airports. They don't have as many planes as a result. So they're just able to be a lot more efficient because they're offering like a different niche. And because it costs Southwest a lot less, they can charge cheaper prices for their planes so that more people will get on it. So that's just like an example. Quickly wanted to get into the difference between operating leverage and economies of scale. So, operating leverage is basically when a company has high fixed costs, because fluctuations in sales have a huge effect on profit margins in both directions, right? Which you can see in the math in the bullet point below. But basically, as we know, when you have financial leverage, that's going to make the equity very volatile, right? Leverage amplifies returns for equity in both directions. It's very similar for operating leverage, except your sales, how your sales, your fluctuations in sales have a big effect on your profit, right? Which you can see in this example. Like if a company with 100 in fixed costs charges $1 per unit and has 20 cents in variable costs, so like very low variable cost per unit, right? Which is kind of the prerequisite for operating leverage, right? High fixed costs, low variable costs. In this case, if sales go down 15%, then my margin is going from 30% to 13.3%. So you can really see here there's a huge change in the margins from 30% to 13.3%, even though the change in sales was only like 25%. So when a company has a cost structure like this, it goes like in both directions, right? But it usually is good and is usually a source of advantage, especially if you're like a platform company or something where like the revenue streams are very stable. But you wouldn't want to be like a cyclical company with operating leverage because then you're going to have a lot of up and down swings by like massive amounts. And then the last thing, economies of scale. I wanted to explain the difference because I think a lot of times you like can get them confused because it's like both are kind of just like decreased costs. Like I think I didn't really understand the difference until recently. Economies of scale is when a company is so large that they have leverage over suppliers, so their variable costs per unit go down. So basically, this is the idea of like Walmart's like, hey, suppliers, I'm just not going to pay that much for my inventory. You need to lower my price or I'm going to go to someone else. They have a lot of leverage because like they're the biggest client, right? They're the biggest one in like the grocery store space. So operating leverage is the whole idea of like spreading out your fixed costs over a larger amount of volumes, whereas economies of scale is the idea of like lower variable costs per unit. So I think this is the last slide, but basically, I just wanted to talk about like the importance of management here because at the end of the day, even though it's their fiduciary duty, sometimes management can overestimate their reinvestment abilities, right? And so much of the value of a company, which is the present value of the future cash flows, comes from like after the next 5 to 10 years, right? So it's really a problem if a company has a lot of the value after these 10 years if you're like trying to value a company because like it's really hard to forecast that long. So you have to really be confident in like things that you can control, like the management team, for instance, because management is basically allocating the capital right now, which is going to create the profits, which then will cause capital to be allocated later. So you have to be really confident that they're always doing what is in the best interest for you, which is just maximizing your value as a shareholder. So the idea of capital allocation, which is basically deciding where capital is going to go, whether it's reinvested back into the business, M&A deals, returning cash to shareholders, things like that. The idea of capital allocation, it's just like super important for managers or management to do a good job with it. But yeah, that's basically it for today. I kind of just wanted to go over competitive advantage and talk about like what a moat is and why that specifically is what allows a company to earn an ROIC above WACC for an extended period of time. But yeah, thank you so much, y'all. Have a good one.